Hi guys, good morning. We'll start with the review of previous week. I want to record this previous week price action and make it for you. Okay, so remember that on previous videos or reviews I was telling you that the relevance or importance of the new week's opening gaps, new month opening gap, and quarterly opening gap. Okay, so let's put the monthly opening gaps, the quarterly, and another relevant point to have in your chart is the event horizon. Normally I don't use it on my intraday trading, like on, for example, if you are using the new week opening gap or like the previous 5 or 6, like ICT said, I don't like to use it on those, but on these high time frame gaps, I want to have it in my chart, and I want you to notice these levels here. Okay, the only ones I have here in my chart are basically these ones between quarterlies. This specific level helps me a lot to navigate the high time frame order flow, because we are moving from a gap to a gap literally, and the 50% level between this is from this level here from this level, the low and the high of the gap, the 50% here, this is the level that you want to have, the 50%. Okay, so on the previous week, this is ES, same. Monthly. Okay, so these green lines are the quarterly levels. Okay, so if you can see, we were trading just at the event horizon, the 50% between this and this, the equilibrium, and note the body closing perfect right here, and then we start to come back to fill all these inefficiencies, this gap here, and find support on this previous, that this gap is from March, and then start to moving higher here. And I was expecting a similar scenario in Nasdaq. Actually, I took a break-even trade on Tuesday, because I was expecting to run to this level and then move higher, but we found support on this event horizon level, the 50% between here, and actually we have this gap here. Okay, so we touch the quarterly opening, that is the opening, the yearly opening, and then close just the next day we close just above the 50% of this gap, and move to the upside to reprice this, all this inefficiency from the weekend. So look the relevance or the importance of having this. It's actually really amazing to have this in your chart to navigate, like the high time frame order flow helps you a lot. because once you are leaving this gap, you are going to refer to the next one. It's really simple, the bias or order flow using high time frame gaps, because if you have like the every new week opening gap here between all these ranges, you can't even see the price action on lower time frames. So having the most relevant, that is the monthly, quarterly, and some weeklies, so then the actual new week opening gap, and you want to have like some more for your intraday trading. But for this chart, I only use like these specific price levels. And even if you want it, you can have the event horizon of the monthly range, because I have only the quarterly right here. Okay, so if you see it from this level to this one, the 50% is this, and from here we retrace to the actually again to the quarterly opening here on April. Okay, so now we have above the marketplace, above us, we have now between these two gaps, we have the event horizon, the 50%, and we have here this gap. Now we are in a really important price range for high time frame, because if we are going to continue to move lower, ideally we should start to look for lower prices around here on ES, on Nasdaq. Look, now we are trading on the February monthly gap, quarterly gap, and we have here above the June also monthly. So now we have a cluster of 3 gaps around here, and we have from this close and this open, this gap here. So I think that if we are going to move lower, we should disrespect bullish PDRAs around from here, maybe from later on the week, like a reversal. This is what I would like to see. If we are going to continue lower, we can do something like taking maybe these highs. Look how they left these highs around here. They just rate this high here. Maybe we can rate it and push this buy side, not only rating and reach the 50%. This is one scenario that could happen, 50%, and melt down to take these sell stops resting below here. This is one thing that I would like to see. But now, for example, we have an S&T right now, but let's see how price close on this specific gap. Now this is another block right here also. Okay, we close above this candle and we find support on the opening, and now we are moving higher. So if we are going to move lower, we should disrespect this specific price range here. Okay, price open, sorry, but we are in premium now on this time, on this candle, on this time frame, because we are trading. If we measure here the 50% equilibrium is here above the equilibrium of this dealing range. We are trading on premium, so looking for longs here. We should long below the regular trading hours gap on intraday to look for higher prices, because we can find resistance on this range here on these levels, and you will experience like deep retracements on intraday, like today price action. So that's what one of my rules that I have for my intraday trading. If I'm looking for longs, ideally I want to long below the opening range gap or at 50% of the regular trading hours gap. Okay, so now let's move on to the 15 minutes chart, and I will show you the trades I took on previous week. I took on Monday. I usually don't trade on Monday. And I think that this is something that I need to improve on my trading, because if the model is presented regardless the day of the week, you should take your trade, but you have to consider the market conditions that you are and apply a specific risk model for that day. So on high probability conditions, like when you find your A plus setup, you should risk more. And this is something that I was studying on past weeks, because I really need to learn how to scale positions better. I can take like pyramid positions, but I need to do it better to in order to have maximize the profits on my trading. And this is something that I'm working on right now on myself. But yes, okay, so this is the gap from Friday to Monday. This is something really important. I was talking with a friend. This price action from electronic trading hours, I'm 100% sure that these candles are used to induce or cause a sentiment in the market. But they or this is how I see it, that at least market makers are placing or moving the market like the huge positions on regular trading hours. So look, for example, this is the opening, the new week opening gap. They moved the market aggressively to the January open, the quarterly opening range gap. And note, even on electronic trading hours, look the candles respecting this level. But the most important for me is look how when we open, we touch like to the tick, this is specific price level. And then we start moving higher. And another important element of this trade, I took actually a trade around here. At the first fair value gap I found on lower time frames, I longed that fair value gap, and I was looking to offset my position above the consequent encroachment of 50% of this gap. This is one of the rules I have. When I'm taking trading against the gap, you are looking for taking partials at the 50% at least, and then the upper quadrant. I don't have here the quadrants, but look here, is the other partial, and then closing the gap. But because this was like 1,000 points gap, I was not expecting to completely reverse the gap on the first day, obviously. So taking partials on some logic point above the consequent encroachment of this gap is something that you should do. And one thing that I like is noting the standard deviations of this specific gap. This was a previous week gap, and I told you this standard deviations are really important for intraday, because you can navigate to the intraday price action if you really know how to use these standard deviations. So we gap lower. This is a breakaway gap because we couldn't close completely the gap. And now we are moving lower to the 4 standard deviation. This is a really important pivot level for your trading. You want to see on these 4 standard deviations intra-week or intraday reversal at least once you have a big run. So we touch the standard, the gap that is inside of the standard deviations that I have from this gap, and now we are closing above this gap. There is a new monthly opening gap. So I was expecting to move at least where? To the event horizon, the 50% of this between these two gaps. And above this level, you can take partials above the short-term highs, like here, because once we are taking short-term highs above these premium levels, you are going to see these reversals or protractions or retracements. And actually, I was expecting on this day, as the day I told you that I took a break-even trade, I was expecting at this opening, I wanted to see to run these sell stops here and make something like this. Take these lows and offset accumulation on this gap and then continue to higher prices. This is what I was looking for on Tuesday. Didn't present it. Why? Because we had that exactly same scenario on ES. We did it. Do you see? This is the monthly gap that I was expecting to reprice on Tuesday. So, and this on Nasdaq we didn't reach this gap here, only on electronic trading hour spot. On this day, I took a short around here because we were trading at the event horizon, and I was thinking from this level, maybe we should move lower to take these sell stops and look for a offset accumulation around these levels, but market just wanted to continue to move higher. Why? Because on electronic trading hours we have here a lot of sell or of buy side liquidity, and we have this gap on field, and we have to completely close the gap at least or to the bodies of this range. So you are going to expect to come back at least to this specific level. Okay, and this day, look, for example, the gap was literally like 2 points. Let's see on the table. This was Tuesday gap. Yes, was 2.75 points the size gap on Tuesday. So it was a really small gap. But yes, we find support at the open at this order block right here, and just move higher. And I took the short here, and you can see the entry on my Twitter. It was a 1 minute chart. I will show you, but yes. So now this is the new week opening gap on electronic trading hours, and this is a new week opening gap on regular trading hours gap, regular trading hours chart. So this is a really huge gap. And yes, so now, for example, here, this was Tuesday, and on Wednesday, I want you to notice something really important. Look how almost every day we are trading against electronic trading hours. Like literally every day. This is short, long, short, long, long, short. So this is really obvious. Like these guys are using when this is important. When we should expect like we are going to respect the electronic trading hours and we are going to move in the same direction that on an electronic trading hours. Well, you should look what previous PM session or market on close did. Okay, so look, we take on Wednesday close. This is really sauce right here, guys. This is how you trust that London made the low of the day. Is your foundation of London. If you want to see if we are going to hold the position, you want to see what the New York session did on previous market on close. Okay, so smart money took the positions from the regular trading hours right here on the close. Okay, so at the opening of the next day, we are opening above this this range of the previous PM session here. Okay, we are opening above, so this is a breaker. This is a breaker on the regular trading hours. This is a breaker here. Breaker on regular trading hours. It's better than on electronic trading hours. Okay, so now look, what is this line? It's the event horizon that I told you. This is a key pivot point for this range that we are moving. And now we have the breaker, and now we have the consequent encroachment of this regular trading hours gap. So this is like a slap the long right here. Actually, this is my main model. My main model is we are trading below the gap, and when I'm not expecting to fully close the gap. This is like I want to see to trade the first imbalance on the 1 minute chart and take the long and ride the trade. Okay, so look how once we reach this 4 standard deviation, we start to navigate and moving to reprice to fully close this gap here. And now above this gap, we have this monthly that is I don't remember the month. February. Yes, February opening gap here. Okay, here. So we are respecting this because I'm not expecting to come back below this range because we offset positions on market on close on previous day here, and we are opening above this breaker. So we retrace to the breaker, and now we are moving higher to this gap or to close this. You should look to take partials to this on this level because you are rebalancing now this previous regular trading hours gap, and this opening price is really fundamental for the market. And you have here 1 standard deviation from the gap, so this is a really good point to take partials and leave 1 contract, or I don't know your size position, leave 1 to this gap, or be above here. We have this on field here. Okay, this was on Thursday, and actually look how these standard deviations when this is the 15 minutes, but you have here you are closing or like how can I say, respecting this consequent encroachment of this previous regular trading hours gap with displacement. So this is key. This is how you should, this is why you trust this imbalance. And you have also the standard deviation here. So this is an area of reaccumulation to offset positions above these highs. Okay, this was on Thursday, and on Friday it was really like a small range day, because now we are fully on regular trading hours. You see how we reach the gap that I was expecting on the market on close on Thursday. So we met the high time frame gap on regular trading hours. So you should not expect like a big move on this day, but it was a decent move because we had a lot of volatility. So it was like 2,200 points move. But yes, so you have now this imbalance from previous regular trading hours. And you are, this is the gap, this is a negative gap. You are opening against the closing price of yesterday. So this is telling you that they are going to reprice some kinds of premium PDRA. And I didn't trade on this day. I was not on chart actually, but the price level that if I were trading on this day, I were expecting to run these sell stops here, but we didn't. We actually, this is our, let me see, the low of this day was 400 and 450. There's 50 cents of difference between this low and this, 25 cents. So 25 points. So this is almost to the tick, this and this. So do you see how now they are leaving these relative equals lows here? This is a hint of now they are building liquidity around here. And when we have this gap on fill here open. So now what we should expect with these intraday gaps. Now we have this gap. If you measure the standard deviations, now we are trading at 2 and 2.5 standard deviations of this gap. What is this? This is an area of retracement or reversal. If we reach the 4 standard deviations here, and this is also the 2.5 standard deviations from this gap, we should expect like a intra-week or intraday reversal here. So yes, this is basically the way I use these both charts. You can trade without the electronic trading hours and be really precise and consistent, but having these like hollow candles helps me to know where is the liquidity from regular trading, from electronic trading hours. I like this a lot. I don't use it like for PDRAs or structure or everything. No, I really don't care about this. Yeah. But I know that retails are trading pre-market hours, and the positions or the stops or the liquidity built around those time frames are fundamental for the market because they want to move against these guys. And you can see how almost every day they are trading against the electronic trading hours. And it is really simple to spot when we are respecting this electronic price action. On this day, for example, today, on Friday, we move against the electronic trading hours to take the buy side here and reprice this gap here. See? And now we take this high, this buy side, we have relative highs here this day on previous pre-market hours from 8:30 and 9:30 opening. We rate those highs actually today. You see, to the tick. And look also, this is beautiful, beautiful. I I love this tool. Literally, this is like I'm in love with my indicator. This is today price action. Note the standard deviations from today's gap. Okay, we consolidate here at around the open and then displace lower. Where? To 2 and 2.5 standard deviations. Okay, this is an important level here, and we touch or we reprice this gap here. This is a total suit model. Then we are moving with displacement against this move. This is a market maker buy model here, smart money reversal. And we are taking the buy side from the opening because retail are shorting, because this is a strong resistance, relative equal highs on electronic trading hours. This is where retails have the stops. This is your draw. And now you are moving against those guys. Where? To take the offset your positions at the consequence, of the lower quadrant of this gap, and 2 and 2.5 standard deviation. This is a logic level to take partials here. And 3.5 and 4. And then once we reach the 4 standard deviation and the buy side liquidity resting above this level, we come back again to the to mitigate these longs here. Now nobody makes money. Now we take the shorts from pre-market hours and electronic trading hours. We induce sellers into the market and we take those positions with this move. And now we mitigate those longs around here. So now we are flat. Smart money now, they don't allow to make money to anybody, right? On this kind of days. Do you see? So these guys, this is how they engineer liquidity, and they use these key levels to accumulate or offset positions. And now I don't have like a whole much expectations, but this was today price action. This was really good for a Monday. I think that this was a really good Monday with no news. It was a good range. Okay, so now we have here this. Now we can take this. We have these sell stops from all pre-market or overnight around here. And this is the upper quadrant of this gap. We can go lower, but let's see to this level. So this is everything for today, guys. It was a really good week, even it was hard. And if you move to the daily chart, if you don't have like these gaps to navigate these conditions, look, you may say, what is this price action? It's horrible price action. This is the worst price action because we are in August and it's the worst month of the year. No, every day is a good trading day if you have the right tools in your hand. and you know how to use it properly. Do you see how even on this chart having these openings gaps on this is really helpful? Look here how we respect this gap here on Nasdaq. And now we are moving to, you say, now we are repricing this. But actually what we are doing, we are coming to these areas, these gaps. Okay. So this is everything for today review. I hope you find this insightful and have a good week. Stay safe.